So everyone's afraid that a bear market is near and the current bull market that we've been in for the past almost 10 years is coming to an end. Now, I don't know if this is true, and in fact, nobody knows if this is true. But in this video, I'm gonna go over some ways that you can actually be prepared if we do enter a bear market. Let's go. So bear market is usually seen as something that's negative. But why is that? Well, the biggest reason in my opinion is that when most investors get involved with the stock market, they go long. Meaning that when they buy a stock, they expect the stock or they hope for the stock to go up over the long or short term. Now that's pretty logical and that's pretty fair. When you put your money into a stock, when you put your money into a company, you expect that company to keep doing well, keep doing better in the future, and give you a good return on your money. Now, if you pick strong, stable, and financially sound companies, even if we enter a bear market in the short term, in the long term, typically these companies will do pretty well and they will go up over time. Now, of course, they can and will get hit during a recession. Some might get hit 10%, some might get hit 20%, some 50%, or some even more than that. But there's a few ways that you can approach this to actually take advantage of this. Now, just like when we're in a bull market, chances are year over year, as long as it stays as a bull market, stocks will continue going up. Now, in a bear market, that's the complete opposite. When you're in a bear market, chances are year over year, stock prices will continue going down. And typically when we go down a lot quicker and more violently than when we go up. Now, good analogy that I'm sure you've heard of and I've heard of personally quite a few times is, think of it this way. When a stock price is going up, it's almost like it's taking the steps to go up there. But when it goes down, it takes the elevator and just shoots all the way down. Now, perfect examples of this is when you look at the recent drop we had in February, where the Dow dropped over 1,000 points in a single day. And just stop and think to yourself, when last did the Dow go up 1,000 points in a single day? I don't think that's ever happened. And that's because, like I said, when stocks go up, it's usually at a slow and steady pace. They slowly go up over time, have little pullbacks, but then continue going up. But when they go down, they can go down from up here to down here and erase months of going up in a single day or in a couple of days. Now, the reason behind this is that fear will almost always overcome the average investor. When there is more volatility in the market, like we saw back in February, there'll be more fear in the market as a result. And when there's more fear, stock prices typically have more violent moves to the downside. So the question is, how do we take advantage of this? Now, first off, I gotta say that I personally do not believe that we're in a bear market right now. I don't think that we're entering a bear market anytime soon, at least not for this year. But again, that's just a prediction and things can change overnight. But right now, as it stands, I do not think we're in a bear market. The economy is still strong, companies are still doing well, and evaluations are still pretty reasonable, which is why I continue to be bullish on stocks that I'm holding and the market overall in general. But that being said, you should always be prepared for the unexpected so you can take advantage of days where we have something like a 1,000 point drop in the Dow. So there's really three ways that you can approach this, okay? So the first way that I want to talk about is when a stock price goes down, you buy more shares. So this is typical and this is pretty much the exact meaning of buy low, sell high. As the stock price continues to go down, keep adding shares in consistently. This will lower your cost basis, and then when there is a recovery and we do exit that recession or that bear market, then stock prices start moving up and you'll start making even more money than if you just had that stock price sit at where you bought it before we entered the bear market. You got to remember that over the long term, if it's a strong company, they typically will do well. But I do understand that this method does require a lot of discipline, and you have to be confident in your strategy and keep adding consistently to your positions. You can't be thinking and scaring yourself into thinking that these stocks are going to just keep going down, never recover, company's going to go bankrupt. Because if they have a strong balance sheet, chances are they will recover from this recession or bear market if we enter that. And that's where you have to keep believing in those companies and keep reinvesting in those companies. At least that's what I would personally be doing to some degree. Now, the second method is to short stocks. if you're not familiar with shorting stocks, it's pretty much that you're betting that the stock price is going to go down. But the way that this happens is that you actually have to borrow shares from your broker. This means that you're going to have to pay interest on it. This means that you have unlimited downside risk. And this typically is a more advanced strategy. Now, I personally have never shorted stocks, and I don't think that I would ever intend on shorting stocks because, like I will mention in a second, the third method is kind of ideal for me personally. There's just way too much risk associated with a short position, especially since there's no limit to how much your losses can be. And if you're not paying attention to this position, or you just don't have the capital to kind of keep putting money into it to lower your cost basis, you're going to be in a lot of trouble when your broker finally says that you got to close that short position and pay them back. So in general, the second method is not what I would be looking at all in a bear market. Now, the third option I think will appeal to most of you, and it's something that I personally will be using quite a bit when we do enter a bear market. Before I get into that though, make sure to hit that subscribe button down below if you've been enjoying this video. I love making these kind of videos. I know you guys love watching these kind of videos, and every subscriber that joins this channel does give me a lot of support. I also appreciate the likes. If we can get this video to 100 likes, I'd really appreciate that. Don't forget to join our Facebook group, Positive Investing, where we have discussions on everything related to stock market, investing, personal finance. If you haven't joined already, it's a completely free group. Link in the description, link in the comments section. Anyways, getting back to the video, I know I strayed off there for a shameless plug, but the third and I think the best way to really approach a bear market is by buying put options. Now, if you're not familiar with put options, you've never heard of what put options are, or maybe you have but you don't really know what they are, how to use them and all that stuff, make sure to check out my video on options. I do have some beginner videos on options, which will teach you about calls, puts, and even how to read option chains. So make sure to check that, links in the description as well. So put options actually give you the ability to make money on stocks when the price goes down, but they do cap your losses. So unlike a short position where your loss is unlimited, your loss is pretty much capped as to how much money you put into that put option. So say you buy $1,000 worth of put options, the most you could lose is $1,000. Now, there are different lengths of put options that you can purchase. You can purchase short term, which are like less than 6 months, maybe medium term, which is about maybe a year or so, or maybe even long term, which could be as much as 2 years out, and they're usually referred to as leaps. So not only will put options provide you some sort of downside protection for your stocks when the price does drop, but it also gives you potential for massive gains. Now, when I say massive, I truly mean massive. When there's a lot of volatility and fear in the market, option prices typically spike up significantly. And like we know, in a bear market, we do have a lot of volatility and fear. So as a result, these option contracts can be worth a lot of money. Now, you can make gains from 100% of your position, so you can essentially double your money. You can even make gains of thousands of percent. Now, that's no joke. Take a look at some option chains if you wanted to verify. There's a lot of opportunity out there for options, and it's actually why a lot of advanced investors utilize options in their portfolio. Not only does it provide some sort of downside risk to their long-term positions, but it also provides potential to make them a lot of money. So you can typically purchase put options either in an index, say the Dow Jones or the S&P 500, by buying options, put options specifically, in the DIA or SPY. But you can also purchase put options on specific companies. So say, for example, you think that if we do enter a recession, Bank of America, for example, will hit something like $15 per share. Now, you can pick up some long-term put options that expire sometime in June 2020 with a $15 strike for around $30 per contract. Now, if, say, for example, we enter a recession tomorrow and Bank of America drops significantly, these options will be worth a lot of money. I'm talking about hundreds upon hundreds, even thousands of percent of gain potential. Now, of course, the way this works, quickly again, watch the video on options, but just a quick summary. If we purchase $15 put options that expire June 2020 on Bank of America, as long as Bank of America comes down to around $15 or less before June 2020, you typically will come out profitable on the trade. Now, of course, you can sell this at any point. Say it happens in the next 4 months that Bank of America drops down to $15. You can sell out of your position with some good gains, or you can continue to hold to have even more gains. Completely up to you, completely flexible, which is why I love put options. Now, of course, like I mentioned, there is a downside risk to put options, and that is whatever you put into them, you're potentially risking. You could risk 100% of what you put in. So say I buy $1,000 worth of Bank of America put options, I could potentially lose $1,000 of that if I held it up until expiration and it didn't reach at least $15. So again, guys, to learn more about that, I strongly encourage you to watch my videos on options. Leave comments in there if you're unsure, if you have questions. I'll gladly answer those, because it's a tool that you should definitely look at implementing into your strategy, because like I said, not only does it provide downside risk, but it also provides a lot of upside gains. So a lot of people don't know that. A lot of investors don't know that. So take advantage of this, understand it, and implement it into your strategy. So now I really want to ask you guys, do you think that we're going to enter a bear market in 2018? I already let you know what my opinion was. I don't think that we will in 2018. We still have strong fundamentals in the market, but I'd really love to know what you guys think. Thank you guys so much for watching. Really appreciate the support. Don't forget to invest positively, and I'll see you in the next one.